Welcome to our Bank on Yourself, Ask an Advisor event. Our host is Pamela Yellen. She's the author of 2 New York Times best-selling books, including her most recent, The Bank on Yourself Revolution. Over 2 decades, Pamela has investigated more than 450 savings and retirement planning strategies, seeking an alternative to the risk and volatility of stocks and other investments. Her research led her to a time-tested, predictable method of growing and protecting wealth known as Bank on Yourself, a method that's used by more than 500,000 people today. Pamela has appeared on every major television and radio network and has served as an expert resource for thousands of organizations and publications such as Associated Press, Fox News, Bloomberg Businessweek, Yahoo Finance, Essence Magazine, Aging Today, and AARP. And now here's Pamela Yellen, the woman who's helped more than 500,000 individuals and families find financial success and peace of mind with her common sense approach to personal finance. Pamela?
Thanks, Lee, and welcome to our special event. We do have a full call today with, checking right now, 987 people on right now. Now, you may be new to the Bank on Yourself concept, or you may have been getting our newsletter for years, or you may be a Bank on Yourself revolutionary, which is what we call people who have already implemented Bank on Yourself in their financial plans. Why revolutionary? Well, because a revolutionary is someone who is fed up with the status quo, someone who knows there's a better way. When you're a Bank on Yourself revolutionary, you're no longer held hostage to the Wall Street casino. You refuse to let banks and finance companies dictate the terms and make the profits on the financing you need to improve your life. And you found a better way to save and pay for major purchases, like automobiles, college, and even your retirement. The Bank on Yourself method is based on a safe wealth-building strategy that has stood the test of time, increasing in value every year for more than 160 years without ever missing a single year. It also lets you fire your banker and become your own source of financing for your cars, vacation, college education, business expenses, or anything you want. But because it goes against the grain of conventional wisdom, which says that you have to risk your money in order to grow a sizable nest egg, some people are skeptical. And many people have questions about some aspects of how the concept works. And that's why I realized there was a huge need for an event like this, where you can get your questions answered and find out if this strategy can work for you, given your unique situation. But because you may or may not be aware of some of the basics, and I'm seeing some questions already being asked about that, I'd like to start by very briefly summarizing what the Bank on Yourself method is based on. And that's an asset that has increased in value every single year for more than 160 years. Dividend-paying whole life insurance. Now, what makes dividend-paying whole life unique is that it provides benefits for your entire life and comes with more guarantees than any other life insurance product. Your cash value is guaranteed to increase by a larger dollar amount each year. Your premium is guaranteed to never increase. And you have a contractual right to access your cash value anytime and for any reason whatsoever. But it's important to understand that this is not the kind of whole life insurance that most financial gurus and advisors know about and love to trash, because there are little-known riders or options added to these policies that grow your equity in the plan, that's your cash value, significantly faster than it would grow in a traditional whole life policy. It's been my experience that most advisors don't even know about these riders, and unfortunately, many who do learn about them won't tell you about them, because adding these riders to your policy is going to slash their commissions by up to 70%. Fortunately, there is a group of advisors who are exceptions to that, and that's the Bank on Yourself authorized advisors. There are only 200 advisors in the U.S. and Canada who have met the rigorous training and qualifications needed to become authorized advisors. And one of those qualifications is to always structure a plan to your benefit and not to theirs. Only 1 out of every 20 applicants is even accepted into the program, and they must undergo rigorous training and testing, and they also have to meet ongoing continuing education requirements. Now I know you're going to want to hear from Bank on Yourself Authorized Advisor Jim Conrad. How many times have you heard that you should never pay a penny more than you need to for insurance? Whether it's auto insurance, homeowners insurance, or life insurance, all the commercials and ads tout lowest premiums and save money on your insurance. Well, for many types of insurance, that's good advice. But Jim is going to show you something that may leave you scratching your head, wondering how it could possibly be true. Jim is going to show you why there is no such thing as paying too much premium into a properly structured Bank on Yourself type dividend-paying whole life policy. Humorist Dave Barry noted that the key to eliminating retirement uncertainty is to plan carefully, save as much as possible, invest wisely, and then, at age 65, get hit by a bus. But Jim Conrad has a better plan he's going to show you, so you can safely turn each of your dollars into many, many tax-free dollars. With a master's degree in business administration and finance, and as a certified senior advisor, Jim brings a rich background in financial services to the table. In the next few minutes, Jim is going to share with you why there is no such thing as paying too much premium and walk you through a client case study so you can see the kind of personalized solution you'll get when you take advantage of a free, no-obligation analysis at growwealthsafely.com. Jim, it's all yours.
Thank you, Pamela. One of the reasons that my clients like working with me is the education process that I take them through as their Bank on Yourself coach. And the education process starts with our very first meeting. The most important concept that I teach everyone is what I'm going to show you today. This is going to be your dollar diagram, and using $1 to keep the math simple and easy to follow, I'm going to prove to you that there is no such thing as paying too much premium into a properly designed Bank on Yourself plan. Let's say it's the end of the month, and you've paid all your bills and met all your financial obligations, and you still have money left in your bank account. We call that discretionary income, and that means you can either spend that money or save it. So let's assume that you put that dollar of discretionary income into your paid-up additions rider. That would be the same as saving it, right? And over your lifetime, let's assume that you live to be 90 years old. That dollar of premium is going to grow safely and reliably to about $9 in cash value. Now, this $9 figure is based on how much time your money has to grow before you reach the age of 90. In this case, I'm going to assume that you're 45 years old now, so your money can grow for 45 years. Of course, if you're younger than 45, your money can grow longer. And if you're older, your money won't have as long to grow. So your number probably won't be exactly $9. Now, what happens if you spend that dollar of discretionary income today? Well, it's gone forever. You just spent it on something, and you'll never see it again. What else is gone forever? More importantly, those $9 that you could have had your cash value grow to in that paid-up additions rider, if you put the dollar in there today instead of spending it. Because you can always borrow that dollar out on a loan basis and pay that dollar back to your policy over whatever period of time you decide is right. Let's say that's 5 years. At the current loan interest rate of 5% simple interest per year, the total amount of interest you'd pay on that dollar loan over that 5-year period is 13 cents. After you pay that dollar back, you could borrow it again over another 5 years at 5% and pay 13 cents interest again. And you could recycle that dollar in and out of your policy on a loan basis every 5 years for the rest of your life if you wanted to. But let's just say you decide at age 65 that you're going to pay back all your loans and start using your policy for tax-free income. For those 4 policy loans of $1 each that you borrowed over your lifetime, the total amount of interest that you would pay would be 52 cents. That interest, which is paid to the insurance company's general fund, eventually benefits you in your guaranteed annual increases, plus any dividends the company pays, while your policy cash value continues to grow as if you never touched it. So let's take that 52 cents interest away from the $9 of cash value that you have over your lifetime from placing that dollar in your paid-up edition rider today. That would mean you'd have $8.48 remaining after all of that borrowing and paying back. So here's a question for you. If you had a plan, your own financial system, and for every dollar you put in that system, even after borrowing that dollar and paying it back with interest 4 times over your lifetime, you still ended up with $8.48. I know what you're thinking. How many dollars would you want to put in there? Well, as many as you could. And with that answer, haven't I proven to you that there's no such thing as paying too much premium, because you've seen the proof for yourself? Now, keeping that answer in mind, let's talk about a real-life example of a big-ticket item. A new car, a nice new car. Let's assume that that car will cost you $30,000. Now, you might want to spend more or less than that for a new car, or you might want to finance some other big-ticket item. It doesn't matter. That's completely up to you. But I'm going to use a vehicle purchase as an example here. We have to assume that you have funded your paid-up additions rider to the extent that you could borrow that $30,000 in cash. Over your lifetime, that $30,000 is going to grow reliably and safely by a factor of 9 to $270,000. You take that policy loan, you go buy the car with cash, you own the title, you might be able to get a better price because you're paying cash, and you decide how long you're going to take to pay that loan back to your policy. Let's assume you decide to pay that loan back in 8 years. Can you get an 8-year auto loan from your bank or your credit union or your car finance company? Of course not. But this is your plan, and you decide how you're going to pay it back and when. So at the 5% per year simple interest rate, that 8-year payback would have an interest charge of 22 cents on the dollar for a total of $6,600 interest on that car loan and repayment. And let's say that 10 years later it's time to buy another car, and you buy another $30,000 vehicle and you finance it the same way. That would cost another $6,600 interest. And let's assume that you bought one more car over your lifetime for a total of 3. The total interest for the 3 car purchases would be $19,800. Subtracting that from the $270,000 that $30,000 today grew to over your lifetime, you would have $250,200 remaining in your policy cash value after 3 $30,000 car purchases using policy loans and paying them back with interest. So what did the 3 cars cost you? Well, 3 times $30,000, $90,000. So you spent that on the cars, but you netted, after paying the loans back with interest, $250,200 in your policy. So here's another question. Knowing all this that I've just shown you, why would you buy a car any other way? Well, you wouldn't. You've got your own financial system. You should use it. You should use that loans feature. You should let your money grow in the policy while you're using it to make those major purchases. Another important question, why would you want to keep any of your money in someone else's bank and let them make that growth on your money that you could make in your own system? Well, you wouldn't. You've got the best financial system on the planet. You want to put your discretionary income, that extra money, into your policy as premium and let it grow over your lifetime. You also want to pay as much premium as you can for as long as you can, because remember, I proved to you there's no such thing as paying too much premium. So if you've got your current policy maxed out, you're paying as much premium as you can, and you still have money you want to put into your Bank on Yourself plan, you simply start another policy. Now, when you complete the Bank on Yourself education process with me, and we have a conversation about your financial goals and your current financial status, I will produce for you a Bank on Yourself personalized solution like this one that I created for my clients, Bob and Donna. We had that conversation about their financial concerns and their financial goals, and they told me their biggest financial concern was having enough money after they finished working. That's probably the same thing I hear from the vast majority of people I talk to. Most folks are concerned about how they're going to fund their retirement so that they live a long, comfortable retirement and their money lasts as long as they do. So it's not surprising that their top financial goal was funding their retirement. Another financial goal of theirs was to pay off their home mortgage and own their house free and clear. They also wanted to finance a really nice trip to Europe for an event coming up in the next few years. And Donna, who owns her own business, small business, told me that she needed to replace a piece of equipment in the near future, and she wanted to finance that equipment purchase. The first thing I showed them in their solution was their potential for lifetime loss of wealth. If they didn't implement the solution that I was showing them, they could potentially lose an awful lot of retirement income that would come to them on a tax-free basis in the amount estimated at about $32,000 each year from Donna's age 71 through 98, which is a total of almost $900,000 of tax-free income. They also knew that they were going to have to buy cars over the rest of their lives, and the interest it would take to finance those 6 $30,000 cars on the outside would be over $44,000 of interest that they would pay others and lose forever. And Donna said, well, that equipment that I need to buy is going to cost about $14,000, and I told them the interest that she would pay on a bank loan to buy that equipment would be over $1,500. So their total lifetime loss on just those three areas, lost retirement income plus interest expense, would total almost $1 million. That's what they stood to lose potentially in wealth over their lifetimes. Can you imagine what it would do with an additional $941,000 to enjoy throughout your retirement years simply by changing the way that you pay for major purchases and save for retirement? In the case of Bob and Donna, they talked about and they let me know how much premium that they could pay. Donna said out of her monthly cash flow she could probably commit to $667 a month, or $8,000 a year. She also strongly believed that she would be able to add an additional $12,000 a year for the first 8 years, assuming her business did well and generated that additional cash flow. So to summarize the plan that I showed them, their total potential income from loans and withdrawals in retirement would total almost $900,000. And even after taking all of that money out of the policy on a tax-free basis for income, there would still be a death benefit at Donna's age 95 of about $50,000. So the total potential benefit to their family was almost $1 million with this Bank on Yourself plan. So I asked them this question after I showed them their solution. Bob and Donna, if you were ever going to implement a strategy that could enable you to take more control of your financial future and achieve your goals and dreams, when would be the best time to get started? Well, they answered that question the same way that everybody else has, right now. So I got them started with their first policy about 5 years ago. Now here's where their dollar diagram comes in. Shortly after they started their plan, about a year later, I showed them their dollar diagram, just like I showed you, and they said, you know, we could probably put more premium into this policy, and we'd like to max it out. That is, put even more than they had planned, because the policy that I designed allowed them to put a little bit more in there. So they understood that concept that there's no such thing as paying too much premium. And they started paying the maximum amount each year, and they've been doing that ever since. After the first year of their plan, Donna was able to finance that equipment for her small business. A year later, they had enough cash value to take a loan and pay off their mortgage, and now they're paying themselves back the way they want to their policy. At the same time, their money continues to grow safely. And a year later, they took their dream trip to Italy, had a great time. Now, your dream vacation might be to another location, or maybe you want to finance something else, like the home improvement that you've always dreamed of. That decision's up to you, but this is what they decided to do with their plan. The results for Bob and Donna have exceeded their initial high expectations. Bank on Yourself has allowed them to achieve financial peace of mind, just like it has for me and hundreds of thousands of other Bank on Yourself revolutionaries. With a Bank on Yourself personalized solution that I will design just for you, I will help you achieve that financial peace of mind too.
Thank you, Jim. Fascinating presentation. There's one question that came up that I'm going to address right now, and that is, why do you need to speak with an advisor to find out how you can benefit from a Bank on Yourself plan? I mean, why can't you just enter some numbers online and have it spit out a proposal? I think that some of that should have been obvious during this event so far, but you really can't, because advisors don't simply take a plan off the shelf and slap your name on it. There are no two plans that are alike. Your policy, as I've mentioned earlier, will be custom tailored to your unique situation and your goals and dreams. Some plans are large, some are small, some are designed to be funded for many, many years, and some for just a few. It all depends on what you want. And there are well over 100 additional factors that will determine what your plan looks like. So let me explain step by step what will happen when you go to growwealthsafely.com to request your free personalized analysis. First, we're going to ask for your contact information so we can get back to you. Then we're going to ask you to look at a list of common financial concerns and check the 2 or 3 that represent your biggest concerns so we have an idea how we can best help you. And then you'll be asked for a little background information, and some of what we ask for is going to be a little personal, but just as the doctor needs to take your medical history, your advisor is going to need to know a bit about your financial history. And I want to assure you that this information is kept in the strictest confidence. You can either submit your information to us on our secure webpage, or you can download and print out a blank form, complete it, and then fax or mail it to us. That form is also available at growwealthsafely.com. Within 2 business days of receiving your request, you'll be connected with a Bank on Yourself authorized advisor who will arrange a time to speak with you by phone to discuss the details of the concept and your specific situation. You will not be asked to buy anything on this call. Your advisor will answer all your questions and help you identify your key short-term and long-term financial goals. They will then create a personalized solution and recommendations report. It'll look something like the one that Jim just showed you today, and it's going to show you how Bank on Yourself can help you reach your primary goals with a custom tailored plan. Your personalized solution is going to reveal the value of your plan on the day you want to tap into it and at every point along the way. You'll know how much income you can count on having during your retirement years and how much you can increase your lifetime wealth simply by using a Bank on Yourself plan to pay for major purchases rather than by financing, leasing, or directly paying cash for them. You're going to find out how you can achieve your goals in the shortest time possible without taking any unnecessary risk. And your advisor will be able to answer all your questions before you ever decide to move forward. Your advisor will then work with you to determine how much to fund your policy with and where to find the funds to do that. As a general guideline, plans funded with a minimum of $250 a month grow more efficiently. But don't rule yourself out if you're not sure you can set aside at least $250 a month to grow your wealth safely and predictably. Bank on Yourself advisors are skilled at helping you restructure your finances to free up additional seed money to fund your plan. Your advisor will then recommend the insurance company with the best plan for your situation, and that company will be among the financially strongest life insurance groups in the country. There are only a handful of companies that offer policies that meet all the requirements to maximize the power of the concept, and your advisor will use one of those companies. After you review your solution, you'll know if a Bank on Yourself plan makes sense for you or not. If it does, your advisor will help you implement your plan and provide ongoing guidance on using it to maximize your lifetime wealth and minimize your taxes. Your advisor will not charge you a fee for your analysis. Instead, if you choose to start a plan, the advisor is compensated by the company issuing your plan. As you saw today, much of your premium will be going towards building up your cash value, so your advisor will typically receive 50 to 70% less commission than if your policy were designed the traditional way. You could soon be on your way to a level of financial security and flexibility that most people desire, but few actually achieve. And the first step to making that happen is to request your free, no-obligation analysis and get a referral to an authorized advisor at growwealthsafely.com. So you can go right now and take that step. Go to growwealthsafely.com. And I do advise you to do that sooner rather than later while it's fresh on your mind. With almost 1,000 people on the call today and only 200 advisors who qualify to be authorized advisors, there's a limit to how many personalized solutions the advisors can do at any one time. Each one takes many, many hours to do, and the advisors are not going to cut short the attention that they put into your plan. So if you delay, it could be weeks or even longer before an advisor could get you on their calendar. Now, Jim, we're still getting a lot of questions about when are you too old to start a Bank on Yourself plan. Here's Janice, for example. She claims that she's no spring chicken, and she wants to know what Bank on Yourself can do for her.
Well, Janice, you're never too old to start a Bank on Yourself plan. My oldest insured was 80 years old when we started her plan. There is a limit of about 85 years old to insure yourself, but no matter how old you are, you can always start a plan and own it on somebody else. You can own a plan on another insured person. Myself, I didn't start my first policy till I was 54. I was pleasantly surprised to learn that I wasn't too old. And my wife and I now own 6 policies. So I walk the talk that I shared in my presentation there, that there's no such thing as paying too much premium, and when you've got more cash you want to put in, you buy more policies. You might be interested in looking at our Bank on Yourself for Seniors on the website, but I assure you, you're never too old.
Jim, great answer, and thank you for mentioning Bank on Yourself for Seniors, because there is a different type of dividend-paying whole life insurance that I have named Bank on Yourself for Seniors plan, and there's only 1 or 2 companies that offer that. And that is that's basically one where you make a one-time premium payment. And there are numerous benefits for that, and you can do that also up to the age of 85, and so it just depends on so many different factors, which one's going to make the most sense for you, whether it's a traditional bank-on-yourself type whole life policy or the one-time lump sum bank-on-yourself for seniors policy. And that's why you'd want to meet with an advisor, because once they know your situation, they can make a recommendation. If they were to try to make a recommendation without knowing your situation, well, that'd kind of be like malpractice, wouldn't it? So there is a lot of options here. Now, we've also had some really good questions about safety. Tom and John have asked questions about how would a bank-on-yourself plan perform in an inflationary environment or if the economy tanks. And I thought I'd take a moment to address that. We hear from a lot of people concerned about inflation potentially heating up and how that might affect bank-on-yourself. The life insurance companies recommended by bank-on-yourself authorized advisors have much of their assets in long-term investment-grade fixed income assets, such as corporate bonds. When inflation drives up interest rates, the rates on new bonds typically follow suit, and that can increase policy dividends as well. This helps offset the increase in inflation for policy owners. And guess what? This is precisely what has happened during high inflation periods in the past. Now, life insurance companies are not in the practice of trading in and out of bonds. They actually have the reserves to hold bonds until maturity if necessary, so they can avoid taking losses, and they can invest new premiums at higher rates. Now, this is a good time to point out that all of the numbers that you've seen today related to the growth in these policy examples are based on the current dividend scale. And current dividends, just like interest rates today, are at historic lows. So as interest rates go up, the growth in these policies will follow. Now, that leads into another question that some people are asking. They want to know what the guaranteed growth would be. You may have noticed a statement on the screen that dividends are not guaranteed, but have been paid every single year for at least the last 100 years by the insurance companies preferred by the bank-on-yourself authorized advisors. What people don't realize typically is what would have to happen for you to receive only the guaranteed annual increase. Well, for that to happen, these companies that have never missed paying a dividend in over 100 years would have to stop paying dividends today and never, ever again pay another dividend. Of course, as they say, past performance is no guarantee of future results. But 100-plus years running is a pretty darn good track record that puts stocks, real estate, gold, and every other asset class to shame. The reality is that dividend-paying whole life insurance has withstood the test of time and has delivered on its promises in both good times and bad. And during every economic condition imaginable, high inflation, deflation, strong dollar, weak dollar, stocks and real estate soaring, and stocks and real estate crashing, and even during the Great Depression. How could that possibly be, you may be wondering? Well, here's a great analogy to explain the difference between whole life as a wealth-building vehicle and most other products and strategies the financial gurus favor. Picture a teenager taking his daddy's sports car out for a spin to put it through its paces and see what it can do. How does he drive? Now, picture a mom taking her kids to preschool in the family minivan. How does she drive? Is there a difference between how the kid drives and how the mom drives? Of course. One driver's trying to get somewhere fast, while the other wants to get to her destination safely while doing everything possible to protect those who are near and dear to her. The insurance companies preferred by the bank-on-yourself advisors are just like the parents of small children. Now, you have been wonderful, those of you who have still stayed on with us this whole time. I do want to congratulate you for taking time out of your busy day to participate and increase your knowledge of this powerful financial strategy called Bank on Yourself. Now, the most common regret people express about Bank on Yourself is that they wish they'd started sooner. Now, I want to make sure that's one regret you never have. Now, you remember that old proverb? The best time to plant your tree is 20 years ago. But the second best time to plant your tree is today. The best time to take the steps needed to take control of your financial future and enjoy financial security for the rest of your life is today. And the first step to making that happen is to request your free, no-obligation analysis and get a referral to an authorized advisor. That advisor will also be able to answer all the remaining questions you have because those questions are so unique to your situation. We've had hundreds of questions asked during this presentation. I couldn't even begin to answer all the specific questions because some of them are so unique to each person, but that's your opportunity to get your specific answer. So do yourself a favor. Go right now and take that step. Go to growwealthsafely.com. That's growwealthsafely.com. Now, if you still have a question, you can also email us at info@bankonyourself.com. Or if there is a specific topic you'd like to see covered in a future event, such as college funding, Bank on Yourself for seniors, or anything else, let us know that too at info@bankonyourself.com. Thank you so much, and congratulations for being here today.